Most families filling out the FAFSA make at least one reporting error that costs them real money. And the worst part is, they never find out. The FAFSA mistakes that hurt the most aren't the big obvious ones. They're quiet little data entry decisions that silently inflate your student aid index and push your expected contribution up by thousands of dollars before anyone even reviews your file. By the end of this video, you're going to know exactly which 8 FAFSA errors that cost money are most common, what each one does to your numbers, and what you can do right now if you've already made one. And before we get to mistake number 5, the one you actually make before you ever open the form, I want to flag something. There's a specific path for families who've already submitted and realized they got something wrong. I'll walk you through that path near the end, because the how to fix it piece is just as important as the list itself. Take Marco. He's in his early 40s, runs a construction business, handles everything for his family, the kind of dad who doesn't miss details. But when he sat down to file his family's 2026-27 FAFSA, 2 things happened that he didn't even know to watch for. His reported income was based on a prior year with an unusually strong revenue spike, numbers that didn't reflect where his business actually was anymore. And he accidentally reported a rollover IRA transaction as untaxed income. Between those 2 issues alone, his student aid index was inflated by roughly $11,000. He's now in the middle of a professional judgment appeal, watching everything he should have caught the first time. His situation touches almost every mistake on this list. Let's go through all 8. The first is reporting retirement account contributions as available income. If you contribute to a 401k, a 403b, or a similar plan through your employer, that money comes out of your paycheck pre-tax, but the FAFSA adds it back in as untaxed income. That's how the form works, and it's legitimate. The problem is when families panic and reduce contributions to look better on the form. That actually backfires because you lose the retirement benefit without meaningfully changing your aid calculation. The dollar impact depends on your contribution amount, but a typical family reducing 401k contributions by $5,000 might see their SAI shift by less than $800. It's rarely worth it. The second FAFSA reporting error is the one Marco made, treating a rollover IRA as untaxed income. If you rolled funds from one retirement account to another, that transaction shows up on your tax return. And if you're not careful, it looks like income. It isn't. It's just money moving between accounts. But a lot of tax software will flag it in a way that's easy to misread, and families report it as untaxed income when it absolutely should not be counted. Marco's rollover inflated his SAI by around $11,000. That's a potentially massive hit to his financial aid package, and it's completely fixable if you catch it. The third mistake is including student assets that should actually be counted as parent assets. A custodial account, a UTMA or UGMA, technically belongs to the student. Student assets are assessed at 20% on the FAFSA, compared to around 5.64% for parent assets. If your student has $10,000 in a UTMA, that's a $2,000 hit to their SAI just from the asset assessment math. Some families don't realize this distinction exists, and some accidentally report it in the wrong category on top of that, doubling the problem. The fourth common FAFSA mistake is counting small business value when you shouldn't. If you own a small business with fewer than 100 full-time equivalent employees, federal rules say you do not have to report that business's net worth on the FAFSA. A lot of small business owner families don't know this, and they include it anyway, sometimes because their tax professional flagged it out of caution, sometimes because the FAFSA form feels like it's asking for it. If you included business equity you weren't required to report, you may have inflated your assets significantly. Now here's the one I promised you. Mistake number 5 is the one you make before you even open the FAFSA, by misunderstanding the prior year income rule. The FAFSA uses income from 2 years before the academic year you're applying for. So for 2026-27, it's using your 2024 tax return. If 2024 was an unusually high income year for your family, a bonus, a business spike, a one-time sale, your aid calculation reflects that number, not what your family's income actually looks like right now. Marco's construction business had a strong year in 2024. That number is sitting in his FAFSA like a financial ghost from a better time. He's been operating on significantly lower revenue since, but the form doesn't know that. This isn't a data entry mistake. It's a structural feature of how the FAFSA works, and most families don't understand it until it's already hurt them. The sixth FAFSA error that costs money is double counting income that's already on your tax return.
Some families report business income twice, once from the tax return the system pulls in, and again when they manually add business earnings in a separate section. It's an easy mistake to make on a long form,
especially if you're self-employed and your income shows up in multiple places on your taxes. Even a few $1,000s of double-counted income can raise your SAI by hundreds to thousands of dollars, depending on your income bracket. The seventh mistake is not updating for a significant income change when you actually can. This ties directly to Marco's situation. If your income has dropped substantially since the year the FAFSA is pulling from, you don't have to just live with a number that no longer reflects reality. Financial aid offices have authority under federal statute to exercise what's called professional judgment, a professional judgment appeal. This allows them to substitute your current year income for the prior year number the form defaulted to. Most families don't know this option exists, and of the ones who do, a lot assume it's too complicated or too unlikely to succeed. It's not, but it requires documentation, a clear explanation, and a properly structured letter. The process matters. Marco is going through it right now, which is exactly why understanding the framework behind it is worth your time. The eighth and final mistake is missing the dependency status question. Dependent students and independent students are treated very differently on the FAFSA. If your student qualifies as independent due to age, veteran status, being married, having dependents of their own, or other federal criteria, their aid calculation is based only on their own financial situation, not their parents'. Some families skip past the dependency questions too quickly and default to dependent status when the student may actually qualify as independent. That's a huge potential difference in the SAI, sometimes tens of thousands of dollars in calculated need. Here's where the fix-it path comes in. If you've already submitted your FAFSA and you recognize one of these mistakes, especially the rollover error, the double-counted income, or the wrong dependency status, you can correct most of them by logging back into your studentaid.gov account and making a FAFSA correction before the school processes your aid. Some corrections are straightforward. Others, like the prior year income issue, require you to go through the financial aid office directly and request a professional judgment review. That's the path Marco is on, and it's the right one for his situation.
The school's financial aid administrator has discretion under Chapter 5 of the federal statute to adjust your information, but they don't do it automatically. You have to ask, and you have to ask in a way that gives them what they need. I built the letter template and the income change worksheet into the pack at FAFSA-appeal.com. If you're at that stage, the fillable versions are there, so you're not starting from scratch. Here's the payoff I want to leave you with. Marco thought he was the anomaly, a guy who made a weird rollover mistake on top of a bad timing year. But his situation is actually the most common profile we see. A business owner or higher earner with one elevated year in the prior year window, plus at least one data entry error on top of it. That combination inflates the SAI by anywhere from $5,000 to $15,000 in the cases we've reviewed. And the families who do something about it, who file the correction, write the professional judgment appeal letter, document the income drop, they get real money back. Not always, but more often than the people who just assume the number is locked in. The number is not locked in. The FAFSA mistakes you made are mostly fixable. The question is whether you know what steps to take and in what order. That's what this channel is here to walk you through. If this was helpful, a like genuinely helps other families in the same situation find it. And there are a few more videos on the professional judgment process if you want to keep going.